Hello and welcome to the DIY Investing YouTube channel. We are working through every company in the S&P 500 and today is Best Buy company, ticker BBY. Over the next 5 minutes, I'll discuss both my valuation for this company and my thoughts on its business quality. So you can see that the business is a $17 billion market cap business operating in specialty retail. If we look at the business description, they retail technology products in the US and Canada, have two segments, domestic and international. It provides computing products, desktops, notebooks, peripherals, mobile phones, networking products, various things like that. So I've been in many Best Buy stores. I know this business decently well from at least what they are, but they also have products under a few other names like Geek Squad, Lively, Magnolia, Best Buy Mobile, Pacific Kitchen, Home, and Yardbird. So let's dive into this company a little bit. When we look here on return on invested capital, it looks pretty good. We do see 2 years of losses over the last 20 years, which is a little high. I'd prefer 1 or 0, but 2 is acceptable. I'm a little curious what this was in 2012, 2013, what was going on, but it looks like they recovered very nicely such that for about a 10-year period from 2004 to 2011, you had very strong returns on capital from 18% up to about 22%, down to about 13%. That's pretty steady and stable. And then from 2015 on, even from 2014 on, you've had growing returns on invested capital, very attractive returns here that look pretty stable as well. So 2015, 20%, 14%, 20%, 18%, 30%, 24 and 34% of last year. So these are very good returns. I like that it's increasing over time. It looks like they're making a very strong change in their business here such that they have a strong return through the return on invested capital. Very attractive here. I like what I see. So when you have returns in that 20-30% range, you're likely to get very strong returns for the equity holders. Now we see 10-year median returns, return on equity 27%. That's great. I like numbers above 15. Return on invested capital of 20%. I like numbers above 10 to 15. So everything looks good here. Now price to earnings ratio of 6.9 is very attractive. For a company with such high returns on capital, you really like to see a PE below 10. That's attractive. This looks cheap on the surface. So I'm immediately wondering, is there anything abnormal about this year? Was the last year something different? Is that sustainable? And so we'll take a little bit of a look at that later as we dive further into the financial statements. But all of these numbers look very cheap. Price to sales 0.3, price to earnings 6.9. This company appears cheap on the surface. Now, 10-year CAGR on revenue says it's 1.3%. That's very low. 10-year CAGR on assets, 0.9%. Free cash flow, 0%. So basically, we're saying it's flat. You don't really have much growth. Now, is that true? Well, it's hard to say. It might be because it's comparing to this 2012 number, and so that's your last 10 years. But if we look simply at 2014 and we say, okay, from 2014, we've grown revenue by 20%. From 40 billion to 51 billion. That's pretty strong growth. It's about a 2% revenue growth over the last 8 years, maybe a little bit higher, 2.5%. And you're seeing pretty steady growth at 6.2%. You had 9.5% growth last year, 8.3% growth the previous year. So those are pretty strong numbers, especially if you're able to sustain what's happened since 2018. This company appears well situated with growth. So this 10-year CAGR seems to be understating the performance of the company. And likewise, when you look at dividends has tripled over the last decade. That's looking good. But clearly we're comparing here for 10 years ago, you have this 2012, which was the bottom in the performance. If you're liking this video so far, please hit the like button and hit that subscribe button as well so you can get updates as I upload new videos. Ringing that bell will give you the notifications as I upload those videos. And I upload investing videos each and every week to keep you informed about various stocks. So let's dive into the income statement. We go to the income statement, we see pretty steady gross profit across the decade, kind of been growing over time, looking pretty good there. SG&A has been held relatively flat, which has allowed your operating profit to go from what looks like 90 million all the way up to 3 billion in 2022. So that looks like a really good, strong number there. You can see they did lose money in 2013, and that's what we looked at before, but they've been a strong grower since then, and so they're in a much stronger place now. One thing I do like that I see here is they've had declining shares outstanding. So they've been buying back shares, maybe not every year, but since 2015, they've been buying back shares, and you see that that's destroyed their shares outstanding over time. And that's a very good sign that we can see there. Now, if we go to balance sheet, how does this look? So you can see they started out the decade with $3.4 billion in property, plant, and equipment. They end it with $4.9 billion. So you've had a growth of about 30%, but you've grown your income a lot faster than that. So that's really good. We can see that they've basically normalized, and they spent a few years cutting out some assets and reducing out your assets all the way down to 2015. They boosted it back up again in 2020. Maybe that was due to some sort of acquisition, some sort of growth plan, but clearly they've been working on normalizing the amount of assets they keep in their business. Their total current assets is flat over the course of the last decade from $10.2 billion to $10.5 billion. So they've been able to boost their income without changing their assets, and that's really been the driver for this growing returns on capital, and it flows through to the investor. Cash flow from operations, despite losing money in 2013, they have had positive cash flow from operations every year, which is a really good sign. Now, they do have stock-based compensation of about $100 to $150 million a year, so that's pretty high. But you can see that at least since 2016, they've been buying back substantially more shares than they're issuing, which is why their shares outstanding has declined. So very good. Let's go back to the balance sheet. How has their debt changed? So long-term debt is actually down over the last decade, which is really nice to see. You've gone from $1.6 billion to $1.1 billion. You do have some short-term debt fluctuating around in there, but all in all, this is looks like a very well-managed company. Clearly, they had some sort of turnaround in the 2012, 2013, 2014 range, but since 2015, they've been operating like gangbusters, and the company looks like they're doing very, very well. One thing I would do with further study is look at how many stores do they have? Do they have a target number of stores? Are they growing the store base? Are they reducing the store base? How are they managing that? Because that's really the driver of how they've been able to, 6x their earnings per share since 2014, and it really makes a strong performance for the investor. You can see the operating leverage in the business where they're able to turn 8.3% revenue growth in 2021 into 19% earnings per share growth in 2021, 9% revenue growth in 2022, turn into 43% earnings per share growth. So clearly they're able to make a huge benefit in keeping their costs down while they grow those earnings, and that's really allowing investors to make a strong return. Now, I don't personally like investing in retail companies, but of the retail companies I would consider, Best Buy looks very attractive. This is a very well-managed business based upon what I can see here. You have very high returns on capital. You have a very attractive valuation ratio. With these returns on capital and with the growth that we're seeing here, paying something like 12 times earnings, 14 times earnings, basically twice as high as it is the current price, could be where a fair value for this business is. So you're maybe trading at a 50% discount based upon what I see. And so very attractive returns on equity, very attractive business model, and very attractive valuation. I like everything I see here with Best Buy. Thank you for listening. And until next time, stop paying fees, start building wealth. Don't forget to subscribe so you can get more investing videos uploaded to this channel.